Well, Tyler, we're officially live. Thank you for hopping on Around the Coin. I'm excited to dive in with you.
Likewise. Yeah, looking forward to this.
Yeah, we were chatting a few minutes ago at how much overlap we have between Flexa's focus on point of sale merchants, preventing fraud. My first startup was in point of sale, and then both of us dabbling in the gift card world. Let's kick it off with Flexa. You've been working on this project that has a very long-term vision. I was reading up on some of the articles you wrote and interviews you've done with other folks. How do you describe the initial concept for Flexa and where you are today? And then, by contrast, where do you expect to be deep down the road?
Oh, wow. Yeah, there's some good, ambitious answers within that. So I guess, the first part is, the longevity or the mission or like what Flexa will start to look like. Even from that perspective, we're already been doing this for more than 4 years, and we feel like we're almost still just getting started because of how long-term the initiative we have and what this will start to look like in the future. So that's like a really big piece of it. And then also, you mentioned the point of sale and some of the other prepaid experience and other things that me and the founders have done. Flexa really is a manifestation of all of that, of learning about things now over the course of more than 10 years of how does this work, how doesn't this work, where's there actually economic value, why will this actually make a difference, why do people care about this, and what's broken about the system, and really understanding all those sort of deeper corners of how all this stuff works, finally putting that all together and saying we are going to do something about this and have a really big, audacious, goal to really solve. And so that said, Flexa simply is just a new digital payment network. It allows any app to use any asset and just pay in-store and online using that app and that asset. So you can open your phone and you have some apps on there, whatever apps they might be that have value. They could be loyalty apps, they could be payment apps, they could be banking apps, they could be crypto apps or crypto wallets, which we're really excited about. And you just take that wallet and you scan something at the store, and then the payment would now work. And you could essentially use something like Bitcoin in a store in real time, instant payments, no fraud to the user. It's literally just that easy of scanning something. And so Flexa facilitates all the software to integrate with all of the hardware, point of sale, the software a merchant already has. There's nothing else new that a merchant needs to get. And then we open up sort of that payments rail to all these other apps. So it's going to be a permissionless SDK for people to be able to access, and there's apps using it now. We're actually going to be announcing quite a few more very, very soon. So it's really open access. So again, very ambitious as I sort of mentioned to that, but in a nutshell, it's just an easy way to make payments. That's the shortest way to describe it.
Do you feel like the initial there's multiple, I feel like in any business or building out a network like this, there's like hills you climb. Do you view the first hill as being the integrations through closed APIs into the point of sale software systems like Micros or Aloha or one of the many other ones out there? Is that what you guys focused on for a significant period of time, is building out those APIs or building into those APIs?
Yeah, I'd say, that's going to be the massive part of our business because as you probably know, there's hundreds of these, if not thousands worldwide. And so not only is it integrating with that hardware, the software to be able to communicate with them and pass authorizations through that ultimately then connect to a merchant system, then the dual edges of that, of this hill, sort of like simultaneous mountains that we're climbing, is not only those integrations, but doing it in a compliant way. So there are hacks, or you can use certain systems, but it doesn't mean that you can now all of a sudden transmit money around the world. And so each jurisdiction that you'll operate in is going to have their own potentially hundreds of years of regulatory approach or how you need to conform or use within those systems. And even in the United States, there's 50 different ones. So having money transmitter licenses in order to do all that. So it's really starting off, the two initial pieces is all the integrations that we possibly can have, and we literally want all of them. And we do have quite a few, to where we're over about 50% coverage within the US itself now, currently. And then getting all of the other various regulatory approvals and licensing and bonds and making sure we're actually operating in just literally the most compliant way possible. Because when it comes to this sort of an approach, you don't get another chance. You can't. We don't want to have fines. We don't want to do things the wrong way. We don't want to take shortcuts. And so, again, having that very long-term vision from the beginning was really critical, right? We had to be all on board with that because we knew it was going to be millions of dollars and years for us to even start getting really going and to have this ability now to start ramping this up the way that we now do, and that's kind of the exciting thing, is that once you do build all of this background and the foundation, it's software. So you can go from hundreds of thousands to millions to, billions of transactions very, very quickly once you kind of have some of these ingredients in place, which we think we have most of them now. So yeah, it's super tiring, man, but I love it. We think we're going for such a big goal that it's happening. So it's still really exciting.
Yeah, I think of it as, somebody has to create that layer that actually touches the point of sale systems. Because if I'm a t-shirt company in Manhattan Beach, California, and I want to start accepting Bitcoin that integrates into my software system, it's going to be, okay, you want to buy this t-shirt, click, scan it. Now what happens? And if that, like, how that integration happens has to be the same on the consumer side. Tell me if you disagree with any of this, but I think it has to be the same on the consumer side at every location they go to, meaning that there has to be, there likely would have to be a middle layer that talks to all the existing software system point of sale systems that are out there, and then also talks to the number of different crypto wallets you could have, presumably without complete indifference to, if you want to use Bitcoin or, name your other crypto. Mm-hmm. Is that conceptually, that's what you think of as the business model, is creating that middle layer?
That's about half. Yeah. So absolutely. Mm-hmm. So what you're describing is what Flexa is, right? It's that whenever you take your phone, or let's say you use something like Apple Pay and you touch it to an RFID reader and it makes a payment, what happens behind the scenes for the merchant to ultimately get paid, that's what we do. And so we're doing it now in a new, more cost-effective, fraud-free way. But then to the user, they don't care, right? They're just going to pay it. It's going to be very easy. They have their wallet. They make a payment. Then stuff happens, and it works, right? That's all they're looking for. So keeping that uniform experience in these other wallets and making it that simple as just a regular tap to pay or a scan to pay, that's totally the goal, and that's what we've built. But also, more importantly, is really on the merchant side. So we already talked about how there's all these different hardware, software, all these other interfaces and things like that. They might have a scanner, they might have a card terminal, they might have, flat, those flat scanners that you see at like grocery stores and things like that. So there's already all that sort of stuff. But let's say you want to use something like Bitcoin. A small merchant could easily use their phone or an iPad or something else to say, I will accept Bitcoin natively. I think it's cool. I want this as payment. I want to support it. And I can do that. I can, maybe get a Coinbase, a Gemini account or something like that. And you can just send crypto to me. It's going to be secure. I can then exchange it for dollars, and that could work for you. But now try to roll that out across, multi 10,000 location store with all different types of hardware, employees that, training your employees to even try to think about that will cost you $10 million, right?
Yeah.
And there's okay, well,
exactly.
Oh, okay. And then even the hardware, right? Okay, now you've got another $100 million across all of your individual locations. And then how does this plug into all the operational software that you have in your accounting? And all of that sort of back of house operational process has been set up for 50 to 100 years. And a lot of these merchants, the last thing they want to be able to do is try to disrupt all of that by saying, oh, we have this great new thing. It's going to be totally separate to anything and anything that you use, right? That's just such a non-starter. And it's like the number one reason why it's not more ubiquitous right now. Merchants just want to get easy payments, right? Cheap and easy payments. So a lot of crypto payments are very valuable from that perspective because they can eliminate fraud, they can be faster, they can have really low acceptance cost. So there has been a lot of interest for merchants to do a lot of this stuff, but it's almost impossible because at scale, integrating it in with your existing, not only infrastructure, but like people and operational infrastructure is not trivial at all. That's a huge, huge thing to overcome. And so that's what Flexa does is we say, hey, we're going to make it as simple for you as just turning on a switch. And everything will look the same. We're going to get money or crypto into your accounts, however you then want it. It's all just going to flow the same. And we're going to have to do all this heavy lifting over years to build all this infrastructure to make it just totally work with all the stuff that they have. And so it's, yeah, that stuff's very boring and behind the scenes, you don't really see it. But that's really the infrastructure that will enable it to work.
Yeah. And one thing you said that just made it extremely not boring is that you said that this is the thing that prevents merchants all over the country and world from accepting crypto. And that's that point right there makes it obviously a big opportunity, but also incredibly not boring. Because if you are able to do this, really, if merchants are able to do this, if they're able to flip a switch and start accepting Bitcoin or other cryptos very easily, then the game changes really quickly. What do you think what is the change in the user experience from go swipe my milk at a countertop scanner, put it in the bag, take out my credit card, stick it in or swipe it? Do you view what would it be like?
Yeah, so I mean, in general, it's very similar, but now rather than having a physical card and an account and all these other things that you need to set up, you literally just use, ideally for us is whatever apps you already have on your phone. So let's say it's a crypto wallet, you open it up, you'd be able to tap a pay button or something. It would create a QR code that you could then scan at the point of sale, or you would scan a QR code like at the point of sale through our integration, and it would just work, and that's it.
Yeah. That's the right way to do it. And then what's happening is that the point of sale system it's saying open up a new payment method that is authorized by Flexa, and then it's reading the QR code, hitting a URL. Is that right? And then coming back with a response that's like thumbs up to the merchant, and that's what approves the payment.
Question. It can work that way, but there's about 50 different ways of what
really?
Can happen. Yeah, because it depends on what interface they have and how the merchant wants to get paid, how authorizations might work in their system. If you're probably familiar through having building a POS, the types of payments or how you communicate outbound to other things can vary. But yeah, that would be one of them. But it's basically just us telling the point of sale, you have now been paid. We will reconcile after the fact. And then the crypto ultimately comes into Flexa, and then we can exchange it or pass it through to the merchant or whatever process needs to happen. And that's where it also is. Flexa does not do that ourselves, and we never will do it ourselves. We're not a liquidity provider. We're not an exchange. And so that's also a part of the network where we really emphasize the payments network aspect, is that everywhere in between all the liquidity platforms we would use, we will have partnerships with them, and we work very closely with them to really make sure we have the right liquidity, the right currencies in all these jurisdictions, and support for all the currencies that we want to see out there too.
Yeah. Does it make sense to start with the U.S., given that we use just primarily one currency at point of sale?
Man, that's yes and no. I think yes, in that there's a lot of, let's say, access to these currencies, and especially as this gets interesting for banking apps where you could just pay, through ACH or your fiat accounts, right? It'll work that way as well. Or loyalty apps, like think of airline apps or hotel apps where you have loyalty points, and now you can just spend those in exactly the same way without having to go to some website and buying a discounted gift card that you're probably never going to use from a brand that you never really even wanted anyway, and all that, right? And then you have to get it mailed to you or some digital code that you're never going to use, and there's leftover value, all that stuff, right? So making that just simple to where you can open up the app and then you just scan something at the point of sale, and you're literally using your airlines app to pay for something, for instance. There's a lot of that sort of opportunity. But it hasn't quite caught on just yet of people using a lot of these instruments yet, or their phone for payments, as they do in, let's say, all throughout Asia. So, from India all the way to like China, we've got 3 billion people using these payment apps, like this sort of experience. And I would say the number one reason why is they use generally central clearing methods to make the payments irreversible and very, very simple. So people are now using this to pay for everyday goods and services. They pay all over the entire country, even in areas that are not cities. You can literally pay without having cash, which is crazy. It works that well, and it's that simple. And people use those payment mechanisms without incentive. They don't necessarily need credit. They don't necessarily need a 2% cash back, or they don't need this, or they don't need, it just is a very easy medium of exchange. And so they use these apps. It's very part of woven into their fabric. It's very easy. They use them. That is not quite the same in the U.S. In the U.S., we have these duopolies that have done a very, very good job of entrenching themselves so deep and making merchants pay for these incentives to where consumers really do sort of require this, even of, oh, well, I'm not going to use this unless I get my 2% or I get my 1%. And I need incentive to be able to spend. And, high value customers can do that, and they can command that. And it's actually, without making it I could talk for a long time about this topic itself, without getting too deep into it or philosophical, it's really a shame too, because when you actually understand how that sausage is made, and that how, when we are spending, right, in the Western world, and certain people have these privileges and access to those cards, who's paying for it, and how goods and services become more expensive, and people that have much, much lower incomes live in perpetual debt funding these payment instruments. And we actually see it, and you see how they're treated by these companies and how they're basically powering this economy. I'll just say, quite frankly, it's very sad. And so in seeing it, and now having a chance to do something about that, that's also something very motivating. Not that we're doing this as social altruistic pioneers, but that's a huge part of it. And that's really exciting to be able to see them kind of break the mold, that economic mold that is, very, very imbalanced.
Are you talking about Visa and Mastercard's 3% fee on everything that they charge as being baked into the prices at retail shops, at stores?
Oh, yeah,
and so if you're saying if you don't have a credit card, then you're paying the price that you're paying that extra 3% because merchants have to mark things up to accommodate for that transaction.
Yeah.
And that's what you're getting at?
Yeah, that's a part. So that was one part that I was mentioning. And then the rest is, let's say they charge a merchant 2%, and then they're giving you 3%, right? There's another 1% missing there. And that comes from the 30% APR that all the people that aren't paying, that can't pay their bills, are subsidizing. So it's basically coming from people that can't afford credit, that have been marketed into getting as much credit as they can have and living in perpetual debt, right? And never being able to get out from interest rates like this. And yeah, I'm not trying to, make all sorts of moral judgments, but it still is the fact that a good sizable percentage comes from, that's where it comes from, right? It's got to be funded from somewhere. And if you actually dig a little deeper, I would encourage you, or even viewers of this, there's a really, really good paper. It's actually a real white paper. It was by the Kansas City Fed, and you can find it. It's very Googleable. It's a public document. And the Fed looks at how much that actually costs. So that sort of loss due to economic opportunity, due to, not having money available to put in interest-bearing accounts, and all this sort of cost of payments. And they actually dug a little deeper of the social cost of payments and how much this actually does cost us as a society. And they came up with a number that said all in, and this is a long paper. This isn't just a couple pages. They have charts and actual pretty convincing evidence of this. They say it's their estimate 2% of the entire US GDP is lost basically due to the cost of literally just making a payment for people. And to put that in perspective, the entire defense budget of the United States, the defense budget is about 3% of the GDP. So that's literally how much we're talking of the cost to all of us collectively of just being able to like make payments to each other, which is completely ludicrous. So
Yeah.
yeah.
Yeah. Well, I will say though that if the alternative, previous to say, if you roll back the clock a little bit, like to exchange value and have a medium of trust between people, I want to purchase that water bottle from you. And so I'm going to give you something in exchange for that that's going to be trusted at other places. Like the amount of value that provided to society over just the pure barter system was like, that had to have been, orders of magnitude. It probably a catalyst for an explosive economic realization that we're now converging at a point where software and now decentralized software makes this a 2% fee seem ridiculous. But I do think, like, if you were to roll back the clock and say, do you want to pay 2% of everything, 2% of your earnings for the year to have this trusted medium? Like, people, for sure, it's something that had to have happened in the past, but also we have to leave this behind and move on to the next thing, just like everything else in technology.
Yeah, it's sort of evolving, right? Like,
yeah.
One like quick thing I'd even add to that is around like, all the discussions right now of digital dollars and the central bank issued digital currencies and what those could look like and how they'll be issued and how people will use them. And that's also something that's super, super important in that, think about now economies that are only using cash, right? They're cash based, right? There's nothing wrong with cash. Cash is great. There's a lot of value to that, although it is very expensive to transact. It's risky to hold. There's all arguments on both sides. But the one thing that is not arguable is that if you primarily transact in cash, you can't buy things online. So now you're basically excluded from the world's largest economy. And if you look at it, economies or countries or cities that are primarily cash-based are generally not that great off economically when compared to the rest of the world. So now even that, without evolving your payment methods and having digital payments and being able to now use this more globally, you are so isolated and unfairly cut off from, world economies. And if you don't want to be a part of that, that's fine too. But a lot of of people, and then guess what? They're probably paying a lot more money for those goods and services when they're isolated into the monopolies of how they're getting in. Of there might only be one store where you can buy something and it's cash, and you can't participate or buy something on Amazon because like you literally cannot use cash. And so creating a digital cash equivalent is going to be something I'm very, very interested in to see how that all evolves. I think it's inevitable it will happen. I'm very skeptical it will happen in the way that I think is going to be as beneficial as it can be, like privacy preserving, for instance. We'll see. I hope.
You mean when you say you're interested to see how the digital cash equivalent rolls out? Do you mean specifically that the Federal Reserve that prints the money in the U.S. is going to have a USD pegged currency that's officially designated by the government, and that's what you're.
It's really
right.
Yeah, it's pretty crazy, right? You see these marketing. The marketing is great. You see things of like, oh, go cashless, or this is cashless. We do not have that. We literally, as in the United States, we do not have a cashless. We do not have digital cash. We do not have that at all. People try to market it that we do, but that's what's often defined as narrow money. It's money that's within, the Visa, the Mastercard, the banking systems, the ACH. I'm not saying this is bad by any means, but it's money that they actually have. It's their database. It's not really digital cash. You're just transacting with, ledgers that they maintain.
Right.
It's not actual digital cash. Your cash is physical. You hold it, and once I deposit into a bank, it's like, okay, well now that's gone. Now you just have a digital ledger, and we'll transact with that between other entities. But it's not really digital cash. It's representation of cash in their system. That's not yours anymore. It's their system, and it works. And again, I'm not saying that that's a altogether bad or terrible system, but we do not have a literal digital cash version. And if we did, I think that could be very powerful in empowering the people to where now you actually could transact in a cash-like manner without needing a bank account, without needing all these other accounts, without needing a card, right? Like, think about how you can become cashless in the United States, like even today, right? You have to have a bank account, which automatically starts excluding people like below 18, let's say, because how do you get a bank account? Well, I need a driver's license or an ID. Well, okay, well, what if I don't need to drive a car and I don't want to drive a car? Okay, well, now I don't even have that. What if, my parents are from somewhere that don't match up in your database of people you like to do business with? Well, now all of a sudden I can't even get into the system to even have cashless opportunity. It's so crazy when you look at all the layers of how this is all built. And so I think there is a really cool opportunity of what that can look like for digital cash. I'm not as optimistic it'll get created in the way that it could, but we'll see. But in the meantime, in long term, maybe we have these other instruments. We have Bitcoin, we have Zcash, we have lots of other things that can be privacy preserving, decentralized networks, and maybe that actually serves as that use case for those sorts of assets being, using that as money. Maybe that is what will turn out. We'll see.
Yeah, it seems like the Tethered USDCs, the stable coins, act as, when I hear you say cash, what I'm hearing is permission. Who or control, right? Who controls the keys? Mm-hmm. If I hold the dollar in my hand, well, I'm literally physically controlling it. If I have it online, and if somebody else can take it from me out of my wallet, then when you say the word cash, the cash is not there. So I think of, if I had Tether or USDC in a wallet where I own the key, is that not digital cash? At least that would be pretty close, right? It's
close. It is close. So I'm very much a fan of those instruments, by the way. So I think it is very close. And maybe that even does start getting to be a really nice approximation of where we can go. And then it also alleviates the burden of a government or even banks having to issue all this stuff and maintaining it. And maybe this is exactly what we could have, which could be very, very interesting. But yeah, there's whitelists, Tether and Circle, they maintain, the keys to those contracts, and they can freeze your funds. I mean, I'm not saying they're going to, so I don't want to try to say,
no.
But it is a little different, right? So there is.
You make a point, right? Because if I own USDC, that's still like a ticket for the currency.
Yeah.
The currency is literally dollars sitting in a federally licensed bank that Tether or Coinbase is maintaining. So if they just decided to move that, or the government came in and took it out of the government's account or the bank's account, right? You're not owning the actual value in and of itself. Yeah, that's a good point.
The other challenge that we'll see is just the privacy, right? That's another reason why they're not like that great yet. So let's say I have an Ethereum account and your address, and you're sending me USDC. I'm an employee, and that's how I'm getting paid. And now I go to the store, I go to you, and I use it to buy something. Well, now you know how much money I make and what my bank balance is. I'm like, that's not how this works. If I pay you in a $5 bill, you have no idea how much money I have or where I'm getting my money. So it's still not there. And maybe there's other privacy preserving. And so this has nothing to do about doing bad stuff. This is just straight up. That's not functional. I should not have to go buy a pack of gum and everyone knows how much money I make and how much money is in my bank account. That is not a good system. And that's how it works now. That's what Bitcoin is. That's what Ethereum is. Like, they're publicly available networks. And that's cool and very still valuable for many things, but it's not quite where it needs to be to really make it this really valuable transaction medium, I think, for commerce yet. But I do think it's happening. And I think it's exciting of what is getting put in place, but it's not quite there yet.
Yeah. And when you set up Flexa, is the organization, presumably it's a LLC or C Corp, that's creating the integrations with the companies, the POSs, and getting the money licenses in the different states in the US. That company is unaffiliated with AMP. I'd love to learn more about AMP and how that's structured. Is that the currency that, in expressing your frustration with, accessing my full salary, is the purpose of AMP to interact with the Flexa network, or any wallet can build on top of it?
Yes, in a somewhat novel way. One thing on the privacy angle too is that when you use Flexa, at least all the payments go to like an omnibus account, or there'll be different accounts to where it's still not, totally, there's a full privacy, but at least it's not going to like a merchant address or something like that. So like no one will know what you're spending on or where you're spending. So again, there's still some strong element of privacy preservation, which we really want inherent to the network. So we do have that, which is helpful. And then, as I was talking about that, what was the main question again? I totally.
Oh, I am. All good. All good.
That's right. I was going to ask something else too. AMP actually only has one purpose. It's a collateral token. So it literally serves as collateral for the entire system behind the scenes of how this all works. So one thing I would want to be clear is that a merchant or a user or people that are sort of using all of this system don't even need to know this exists. They don't care that it exists. They don't need to buy it. They don't need to hold it. They don't need to see it. They don't even literally need to do anything at all. So I would say everything I just talked about so far, even up to this point, if you're a merchant, a user, any of this stuff, that's all 100% true. And we can almost stop the conversation and everything is good, right? And so now, when you get into the guts, though, of how some of this can work and why now and what technologies actually power this and what's unique about it, AMP actually is the main ingredient. And so now, if we're going to have this open network that allows any app to now make payments into Flexa, right? Because we're not trusting you. We're not setting up business relationship deals or contracts. We say, hey, you have an app. You want to start using Flexa? You can. And your users can now start sending funds into Flexa. And we're going to make all these payments instantly in a store, right? Instantly, right? No waiting, nothing else like that. And so to do that, there would be fraud on the grandest scale possible because people would basically not send the transactions. And we would just be authorizing all these payments in real time. And people would just not send the tokens to us. And the wallets would just not do it eventually, right? And so the way we stop that is for a wallet to permissionlessly access the network, they have to pledge collateral behind the scenes into a smart contract, and that's what the AMP token serves as. So let's say there's $100,000 worth of AMP collateral of the tokens in a smart contract, and for wallet X, then Flexa, the network, would say, oh, wallet X, I'll let all of your users spend whatever assets they have of unconfirmed transactions up to $100,000, and I'll just let them all through. And if you cheat, I'm going to take the collateral and I'll liquidate the collateral and I'll make sure everything then gets whole. So now if a wallet ends up cheating, it's really just defeating its own stake that's there. And it's really similar to a proof of stake validator in a proof of stake network, if anyone's familiar with that, where there's, if you behave inappropriately, you will get slashed to make it economically not viable for you to do that. So everyone ends up behaving honestly in the game theory of this, and then it all works out. And then one of the other really important pieces is that all of the fees that Flexa collects, the smaller fees that we do charge merchants, we use to buy the AMP token, which is a fixed supply token, and that gets distributed back to the people providing the collateral in the first place. So what all that just means is if you provide the collateral, you actually earn all the fees in the network. So there's a lot of incentive now. Yeah, there's economic incentive to act honestly. You get the utility of being able to spend assets now in real time automatically. And then the third part is that you make all of the fees. So you're like literally becoming you're providing the collateral, you're doing the work, you're putting up the risk, you're going to earn all the fees in the network, which is now we've seen very compelling also for wallets and just the growth of the network. And that was also very deliberate of having a token very specialized to do this because it now provides this deeper economic incentive of people now using the network for a very long time, and they have lots of incentive to continue building on it, and rightfully so, right? They're earning, the work that they have to do and the risk that they have to take.
As a quick parsing out how the incentives get passed on to the stakeholders, when a wallet sends a request to approve a transaction and it's unconfirmed, the wallet has to have a smart contract with, in your case, $100,000 or the amount of the transaction volume or less to make sure that the wallet doesn't retract the transaction. When that money gets sent, it goes from the wallet to, where would it go to exactly?
Oh, it goes to a Flexa exchange account. So it literally just goes to one of our exchanges. And then if the merchant wants Bitcoin, we could just give them Bitcoin. But if they want dollars, we would exchange it for dollars and then route that through the banking system accordingly. And it shows up in a merchant's bank just like any other payment.
Right. Okay. And then if I'm staking the 100K, am I staking that? Would the wallet be staking it, or individuals would stake it
That's the
in
cool
return?
thing. It's permissionless. So the wallets will do it, but actually anyone can do it. So it's not exclusionary. So the wallets will do it, and they are doing it because they're selfishly wanting to earn the fees that they're generating. But anyone in the world, if I just see, let's say the Gemini wallet, because Gemini is now using Flexa. So if you have the Gemini app, you can use all the assets in Gemini and literally pay in stores like this literally today. You can literally earn all the fees or a share of all the fees that the Gemini app is producing. Anyone in the world can just go stake AMP into that contract that's designated for Gemini. And now all of a sudden you're participating exactly the same way as an individual.
Right.
Yep.
And as me, who I'm staking it on behalf of the Gemini wallet, I'm effectively banking on the fact that Gemini is not going to fuck over other people. Because if Gemini could, right? That's effectively
absolutely
the
could. And so,
right.
Will they? Probably not, right?
Probably not. Right,
regulated, they're insured, and all that, right? So, but technically they could, and so that's where it's really cool because that's where the risk profiles will start to get developed over if you want to stake certain apps. And maybe there are certain apps that are just not really worth the risk, and they're going to have lower collateral. Maybe they're going to have higher APYs, but it's not maybe worth it. Whereas some of these other very established and safe wallets are going to do a lot more volume. They're going to have a lot of users, and it's inherently going to be these sort of risk-free rates that you can see develop within the economy, which will be pretty neat. So that's something I studied a lot in the AMP white paper, if anyone cares to look at. I actually cover an entire section around how the dynamics of that can start to unfold and what that means for volatility, and I kind of dig a little too deep into it. But it was really fun putting
No, that's amazing. It's effectively taking the transaction fee from Visa, Mastercard, which the value they're providing is trust, right? When I swipe the card, the merchant knows that they're going to get paid.
Exactly.
And in exchange for that trust, Visa, Mastercard take 2.5%, 3%, which is a huge amount, like you said. In this case, when AMP is staked and the wallet sends the transaction through, does the fee that the staker, it's not the is that what it's called?
Totally
Staker.
right.
Yeah,
Sure.
staker is called. Is that coming from the consumer? The consumer is paying a slightly higher rate?
No, it's coming from the merchant as it does currently with the other card networks, but it's just a much lower number. But so when I mentioned how a payment will come in, right? So let's say it's $10 and actually makes it 100 because the number is easier to visualize. It was $100. We would actually only pay the merchant $99. And then there's $1 left over. And then that dollar will be used to buy AMP and then get sent back to the contract. And so, right now it's a fairly manual process, how we're doing that. And there's lots of reasons for it. It's because we don't want to use the best technology for it. What chains or what contracts will all be used to make that work very well. And then there's another privacy piece that gets layered in that's also very challenging, which is if you're a merchant, do you want everyone in the world to know how much people are spending at your stores using these networks and what assets they are? Because you'll be able to tell based on the rates, or you'll be able to guess based on how much money is basically flowing into those contracts. So that's another issue, and actually much more of a competitive issue because merchants no one knows how much money Home Depot is making in its stores based on Visa revenues, right? That would not be a good system either. Just like how we talked about, I don't want you to see my bank account, merchants, that's hugely competitive data. They can't use a payment network where now all this data is revealed and guessable of where people are spending and how much and all this. So we're the easy way to do it, not easy, but a standard way would just use a zero knowledge contract, which are now actually getting pretty prevalent. There's quite a few that are very compelling that are already getting now in real use now, where we can now send the funds through that. it can actually then publish all of those funds into these contracts. And now you'd be able to know that your number or your result is correct without knowing the total number that's in the pool, which is pretty cool. So yeah, and we're not going to invent that. We are not mathematicians on zero knowledge, pushing the envelope on zero knowledge contracts, but lots of people are. And we'll start using the ones that are the best. And so that's really been our approach for Flexa in general, too, which has been a little maybe atypical, at least from expectations, especially within like crypto worlds of do it now, do it now, do it now, use this, fully decentralized. You need to have this. Why don't you have this? Why aren't you? It's like, okay, well, we have, again, 10-year horizon. We're trying to do something massive. What are we going to uniquely do really, really well, right? We're going to make these integrations. We're going to get this in place. And is it very important that we have the private transactions? Yes. Is it very important that we actually have funds getting distributed back into these contracts so merchants, those amounts are revealed? Yes, absolutely. But we can just centralize that stuff a little bit now and build it all out and make it all working. And then also, I don't want to paint a target on us or anything else, but like we've not ever lost any money yet. None of our contracts have been hacked. We haven't lost any funds. There hasn't been any of those other issues or vulnerabilities or exploits because we are methodically approaching this as a real tried and true massive financial services business where it's not about experimenting with some of these new technologies right away for the sake of doing it. So it's what's really valuable. Let's build and we've had all these other audits, all the costs that we've had, all the tests that we've had, and we have our Flexa capacity contracts and the staking contracts, and we're very proud of those. But yeah, taking certain centralized measures as prudent, while still maintaining a decentralized nature to where even with us, if Flexa goes away, we have fail-safe mechanisms in the contract where people can still get all their funds back out without us doing anything, right? So we can't even stop it. But it's reasonable. And we put a lot of time thinking about like what really makes sense, what gets this adoption, what gets this really big and creating the volume and getting this to really work. And then as it's valuable, now adding in all the other cool stuff and adding in all the other things that will be table stakes, but you don't need a lot of that stuff right out of the box. And sometimes people think that you do. And they spend a lot of time, money, and effort building stuff that either doesn't work or gets compromised or, quite frankly, is not the magic ingredient to really make this stuff work. So,
yeah, I agree with you on the observation that there is a strong cultural encouragement. It's kind of like in high school, everyone's pushing for a certain, style as of genes or something. It's like everyone says you have to be decentralized and everything. And I think that comes out of an acknowledgement over what makes crypto special and what makes decentralized protocols and applications special is the decentralized nature of it. And so you immediately, as humans, we attach onto that and they say, are you part of that club? Are you in the completely decentralized? Because that's how we measure, what projects are cool or not, which is kind of to lose track of the traditional way to build startups. I mean, if you think about it, the startup mentality as pioneered by like Paul Graham and YC is do things that don't scale. Like it's not go out and build a hyperscale company as quickly as possible because they recognized over many painful experiences that if you think about scale right off the bat, you build, as engineers, you build it for scale and you have 25 users. Yeah, it's just like that ends in a graveyard. And so I think the same lesson probably hasn't quite been learned yet on the crypto side, decentralized side. It's like, yeah, man, you could, if you wanted to, let it rip and make it completely decentralized, but there's a lot of big price to pay.
And the other thing too is that for me, it's a lot of responsibility. So that is going into the mantra you mentioned, right? Facebook set up, go fast and break things, right? Like I appreciate that, right? As an actual real engineer before, now more on the business side, but like prototyping, moving things quickly, getting software out there, just shipping stuff that's broken. That is the name of the game, and that is what we should do, and that is literally how companies can grow. Okay, but now if you're doing that with people's money, that's a different game now. It doesn't mean that everything needs to be perfect. You can't always just have everything perfect, but let's say you could release a fully decentralized contract or something and just put a limit on it then. I see this stuff on Twitter, which I think is like just the most brazen, irresponsible approaches with people that, like to talk their game and everything else of, hey, I just released this other thing. Hey, it's, financial risk, your responsibility, do your research. It's like, okay, well, how about you not let $100 million go into that contract? You could build it and let's test it all out. How about you limit it to like $10,000 for a little while and maybe up it as people are using it? How about you can throttle things, right? Don't just let the whole thing.
Yeah.
Right. And that's what often happens. And then that becomes a target before it's actually fully tested. And that to me is like just callously irresponsible. And individuals, it's on them, right? Like, you can build that stuff. You don't need to go right up, away. Like, think about these things. This is people's money. And even if they are being, you could say it's their responsibility. They're the ones that are putting the money. Yeah, sure. But I don't want to enable that. And
and also, it's not really how the world works today. When it comes to regulation, the government is way more likely to come in with a strong and overbearing hand when they feel like companies have no throttles in place for reasonable assumptions on how people make financial decisions. Like I was talking to a guy a couple of days ago, and he is working on this business that connects credit unions with lending APIs. So like you can go to, you want to borrow money, you can go to credit union. Well, when it comes to borrowing money, there's a lot of legal considerations and what regulations allow, but there's also like, you don't want to make any loan to anyone who you think won't pay it back or can't pay it back. And in the crypto world, it's like that hasn't quite, the mentality is like, oh, individuals are going to decide. And I mean, dude, I'm all for like libertarian mindset when it comes to this, but I do recognize that if you just let it rip on that mentality, then people will make mistakes and they'll complain to who? They'll complain to the guys with guns that run, the Capitol building and the police and judicial branch will get involved, and now we'll have terrible rules. So it's like, I think it's important, I think you articulate it well, but I just encourage you to keep pushing back on people to understand the reality of the world we live in and not pretend like it's some utopia where the government can't get involved and, ruin things for a while.
And just even support, right? It's not what it's about, right? We don't want to build all this stuff, just lose people's money. Like, that's not, no one's trying to do that. And so you really should just have that, internal mindset of like, okay, do I actually have other people's best interests in this? Sure, I can make money. I'm still going to do the same thing, but like having just responsible limits and you can go from there. Like, I'm not trying to say, hey, limit your business or limit, we're trying to shoot for trillions of dollars in what we're doing. Like we're going as absolutely big as we can, but we have to take the various steps unique to us to get there. And it's the same thing. If you want to build a permissionless bridge between Bitcoin and Ethereum, right, trying to compete with wrapped Bitcoin, right, which is a custodial service. If you want to build a permissionless bridge, how about you don't make it unlimited day one and let everyone just throw a whole bunch of Bitcoin into a contract that might just be lost forever? Why don't you just start it off and test it with like 10 for a while, right? And like, it's just throwing it out there for people to think about. Like, these are just very responsible things that you can do. And to say that, I am not accusing by any means of people acting intentionally or not testing it and not doing other diligence. So I'm not saying that, but there's other constraints you could add in that I think add another layer of legitimacy, and then people, working together on this stuff rather than losing a bunch of money and say, well, I told you it was beta. Right, I put the warning on the site. It was beta. Like, I don't know, you might lose all your money. It's like, well, So it's like it's like that little, the checkbox you sign when you scroll in the, you buy an iPhone and says you accept these 35 pages of terms of service. It's your responsibility to read them all. Yeah. How did you decide? One thing you said earlier, I was curious about is how did you decide to have a fixed, or why did you decide to have a fixed cap on the AMP? And then how do you decide some of these parameters, like how much to issue, or if there was other sort of parameters you had to choose in setting that up? Yeah. So one piece is that all of this was way more thoroughly engineered and thought through and strategized than probably anyone will ever care about or give credit to. Both my own nature, as you probably hear me, talking about various things, I tend to be very over analytical of how we approach various things and looking at it from various facets, as well as the rest of the team. And so there's been a lot of time, effort, and otherwise. Not that everything's always right, but it is very much well thought through. And so the two specific points, one around just like the total amount of tokens, it really depended on ease of use around the expected market cap of like what the tokens could look like versus to get the right utility out of them versus like other projects, what was out there. People don't like thinking of 0.000015 of something. That's very hard to conceptualize like what that actually means. And they also don't like thinking in hundreds or thousands of something. So we tried to pick something out where based on the use and what could then be reasonable, having enough supply where you're going to have things in, $1, $10, $20, things that are much more manageable. So we didn't want to be on the either side of the spectrum. And so we found that given where it was at and how much utility we think we can get and like the market cap based on payments and all these other sort of things, it settled into a number that we chose. And then, maybe if it goes up in value way beyond that, there would be ways to, maybe have interfaces or something that can make the units more palatable for people to see or understand, like a stock split or something. We couldn't literally do that. We can't control the contract. We can't update it or anything like that. But visually or within an interface, maybe there's things you could do. And hopefully that'll be another, problem for the future to even look at. That's the, the first thing is that. And that's why like Bitcoin is really challenging, right? Like off the top of your head, you have no idea conceptually what 0.0023 Bitcoin is worth, right? Like outside of just a unit. And for us, and some people would say, oh, it's Bitcoin, that's the unit. It's like, okay, fair. But with us, we're designating it in capacity for spending in the local currency. So its currency equivalent is very important to us. So we couldn't have very small fractions. We didn't want 10,000 unit tokens, right? That's just, it's not like easier to understand. And it also then feels very unapproachable for people. And we've really built this for lots and lots of people to participate as well as large organizations. And then
it almost feels not to cut you off, but it feels a little bit like in the US because we export the world's largest currency and sort of the standard of world currency. And we deal in single digit denominators like 1 USD. Like if you're sending money to Argentina, the Philippines, you might be, or other countries, they might think of like a pair of shoes might just cost 27,000 pesos, shekels, or whatever it is, and like they seem to be fine with it. Is that is that an actual inconvenience?
For sure, it's a local bias of us and our market of perceiving it that way. So I would definitely admit that, But it also is easier to start with that unit of account and make even the math easier, right? So if you're in the Philippines or you're in Mexico and you have to multiply a certain amount, like it's a lot easier to start there than actually have to retrograde back into two other calculations of other ratios. So we'll see, but at least here's manageable there. And then the fixed supply, I guess, was the other part of the question. That was it was kind of easiest of, in order to get buy-in and long-term incentive, we don't want it to be diluted. So if you have collateral in a wallet, every new wallet that joins has to acquire collateral. So the pool actually starts getting smaller and smaller of the available collateral. And that also is by design because that's good economic incentive for you to keep your collateral locked and get the payment utility. It would be terrible if you were built a wallet and you're getting moderate activity and the value of your collateral is going down on a per capita basis. That would be terrible. Like it's like, I don't want to use the system anymore, right?
Sounds like my bank account.
Yeah.
It's like the more dollars they print, the less it's worth.
Right. So it's like, forget about token price. Like I'm not even talking about speculation or any of that stuff. It's literally just pure utility of, if I bought into a system to use this system, and then 5 years later, my use has depreciated tremendously, like that is not a usable system to me. Whereas if the utility goes up and the value becomes higher, well, that's great. This is something I will invest in from an actual utility perspective, and not because I'm speculating on this of, I think it's going to be worth more money. It's, no, I actually feel comfortable in buying into and having ownership of this functionality And now I can, ride this longer, knowing that I'm actually, my kind of part of the network remains the same. So if the network does very well and payments continue to thrive in the system, well, hey, I'm in a really great situation rather than some opaque emission scheme or printing more tokens and infinite amount of tokens, right? It just makes everyone not feel like they know the game. And, especially when you look at like proof of stake networks, right? They often talk about like, oh yeah, you stake the network and then you get the new coins, the new emission, like you get the inflation. Well, it's like the opposite is also true, where if you're not participating, you're losing money. So it's kind of like a tax on everyone, right? So if you're not actively doing those things, you're actually losing money in the system because you're not getting the inflation component. And then it's like kind of disproportionately rewarded to people, which sucks. So we did not want that to happen. We wanted the people that are using the system in from the beginning, using this, finding the utility, right, to have that long-term benefit as well. And so you really can only achieve that with a fixed supply. And also sometimes people would say, oh, well, you could burn the tokens, right? So rather than actually distributing them back as like rewards and purchasing them, why don't you just burn them? That's way better. I was like, well, that also doesn't align with economic incentives too. And you've actually seen this. I won't name certain projects, but there's been a few large projects where they burned like half of the supply, right? And does that mean that now the token that I used to have is now worth to someone else double what I just paid for it? Like, no, right? It doesn't matter. It doesn't instantly change the value of anything. It might change your perspective or perception of it, but it doesn't immediately impact the price or the value or the utility of something. So I actually think that's kind of and it's when you're burning tokens, it doesn't actually reward the person that's necessarily creating the burn, right? So imagine if I were to spend something on Flexa and AMP tokens were burned, everyone sort of indirectly in the slightest way might feel that in some way, like the slightest way. But that's really not what you're going for. What I want you to do is stake your tokens, you provide the risk, and you are getting the reward. Not everyone else, right? I mean, the network can grow in ways, but it's your activity will generate the benefit, right? And I'm not trying to get around or talk about securities, utilities, and all these sorts. It's just literally the facts of how this works way better and what makes this more sustainable and having true utility in a network. It's not about trying to fit a framework. It's literally what provides the best economic outcome, the most secure outcome, the safest outcome, and literally just the most enriching outcome is that. I'm going to do the work. I'm going to get the reward. And that's great. And so that's the way that we really put that together too, rather than some of the other models that people really advertise and they promote, but I just don't really think are as effective. And just my opinion from what I've seen, I haven't seen them be as effective as a model like this personally.
Yeah. And where are you now, or where is Flexa now in terms of however you measure traction, progress, money raised, or wallets?
Yeah.
You got Gemini is a big one.
Yeah. So there'll be quite a few more that we'll be officially announcing. And then we're doing quite a few things where wallets will be able to start joining very, very fast onto the network. It's really the main metrics are just around the network growth. So it'll be around volume, and we'll start when the technology allows that to be sort of shared most responsibly. And as the numbers get really nice and impressive, as they're starting to, we'll start sharing that a lot more. So that's going to be like kind of a high level metric. But currently it's a lot of the merchants and the wallets and even the currencies supported. So we're at over 100 currencies that we support now, or tokens on the networks. That was a big push. We're announcing a bunch more wallets, and then now quite a few more very large national merchants that will be upcoming. And so it's
nice.
Yeah, it's sort of like people are, often saying, like, oh, what are the updates, or what are you doing? It's like, well, we're doing the exact same thing we did like 4 years ago.
Yeah.
It's doing those things, building all the scaffolding to make it happen. And we've been announcing more payment service providers and other tokens and things like that. And there's things happening for sure. But it's really just keep growing both sides of the network bigger and bigger and bigger. And then hopefully before we know it, a lot of these wallets on your phone, you'll just be able to go spend nice and easy anywhere. And it'll just
it's awesome. I like the business a lot because it involves it's certainly a business model innovation, but also you have to do a lot of grunt work in all of the money licenses and international considerations and all the POS integrations that just, I mean, if I'm a founder, I'm like, oh God, I don't want to do that.
Don't do it. Don't do it.
Let these guys do that and just use the network.
Quite frankly, it is literally for founding teams like us that have done it multiple times before. We know what we're getting into. We know the slog it's going to be. We've been beaten up over decades of doing this before. We know that, like, don't do it. I would like, there are so many other really exciting businesses to do. This one is really like all the stars aligning to have the opportunity to do something really, really massive that appeals to us. And then we know all those pieces, and then we can just, sustain another 10 years of having to climb up 3 steps up and 2 steps down and 3 steps up and just keep going. And
totally.
Yeah.
And how did you decide to choreograph the funding aspect of it? You have AMP, Flex is an independent company. Is it like typical startup, like raise money, VC, give out equity in Flexa, or is it
actually not at all? So that's been very, very strong, and I'm so excited where it's ended up. But it was very hard starting off in that we did not want to be like a lot of other projects, and there are some, marquee projects. Well, we have this entity, and then we have this network, and we'll sell you these tokens, and this is our labs, and this is what we didn't want to do any of that. So literally, and you can see in that model, right, all the fees that Flexa earns are going into the token. So all the value essentially that Flexa has generated is in the token. So it really is a true token network to where AMP has all the value of what's like generated. So we wanted to be true to that. And we think the only way that, and that was hard, especially with some of the entities that we've ultimately had participate in the network. They've only bought tokens. So every single person that has financial interest is really through the token. We've really designed this where we don't think the entity will be worth very much money, right? Like that's not really where the value will accrue. Like there will have to be an entity that, continues to push that aspect of the business forward, and that'll be there. But it's really about all the value in the token. So the people now in the network, there's been a few what I would call VCs, but they were pretty early. And it's mainly people that are using the network. So we've been really selective about that as it's kind of gotten off the ground. Had anyone that's in, whether it's a merchant, a service provider, someone in a wallet, someone using Flexa, those are the people that the majority of the people that own the tokens currently. And that's the way that we'd really like it to be. And that's not that others can't participate. Like I said, it's totally open, and people want to participate and stake tokens. They absolutely can buy them on, public exchanges and things. But like for Flexa and how we've distributed tokens, even now through upcoming grants and other sales, it's literally been predominantly through people that are using the network itself, which builds the real network, right? These are the people that want the thing. They're not buying it because they think that the tokens are going to go up a lot in value. They're buying it because they literally want this to exist, and they want the utility of it, and they're literally buying the tokens to participate and use the thing that we have.
Yeah, that's a good litmus test. And to pay your team on Flexa, you would sell the tokens that Flexa as a company owns periodically.
Yeah, exactly.
Yeah, that's very clean. It's a good way to do it. And presumably somebody could, I'm picturing, all right, Tyler, we got the CEO of Visa on the line. They want to offer you $5 billion for the Flexa company 10 years from now. Is that possible to consider?
Really, because they have to buy all the tokens. So, they're welcome to do that. Like anyone could do it, right? We can't stop you from, they won't be able to buy all of them, but
couldn't they buy the Flexa corporation that has all the money licenses and integrates all the contracts with the companies?
Bill, see, here's the thing though. This is where you get the incentives also, is that for us and founders and participants, we have lots of tokens that are valuable, and that's where our value is generated. So if we were to sell like an entity or something, it would be short selling everything else and all the opportunity that we might have. And I suppose there's maybe a really odd hybrid where it could still kind of come together. So I don't want to say like never, 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 but it's probably never. It just doesn't.
Yeah.
That's not really what it was built. And the way that this is built is in a different business model. It's literally directly in competition with everything that's there. It's really not compatible with them. So this was honestly never built as an acquirable business. This was built as a decentralized payment network that now people, all over the world will own these tokens, and it can go on forever. And it's really not designed that way from day one. So yeah, I don't think it can be acquired.
Yeah.
It just doesn't. It's not set up that way. It's not really built that way. Very much by design, because then all this ends up being is a new payments network that's like all of the others that maybe uses some different technology, and maybe that can succeed, but that's really, really hard. You're going against an incumbent. You're competing on a very level playing field with them having 1,000 times or 100,000 times more money than you. That's not. I don't want to fight that. I want to go in a totally unlevel playing field with a business model that's somewhat radical, even where fundamentally it's very boring and looks all the same, but how it literally works is fundamentally very different and isn't compatible with those. You're decentralizing risk in payment transactions now, rather than having one entity make these calls and charging lots of money for all of this. It's sort of designed that way from the beginning to be very, very different. I can't, in this instant, foresee an acquisition of any kind that would ever make sense that people could ever. I just honestly can't. And I'm not even saying that out of like arrogance or, this is going to be so great. It just wasn't designed that way. I don't think it's possible. So that's surely not at all what we are going for. And if we ever got to a state where there was an offer that was even remotely compelling, I can probably say that the alternative would be far more compelling. If this gets anywhere near the radar of some centralized entity saying any amount of money, and that means there's something way bigger here than we're even talking about. So again, it's sort of like the context of, sure, there's always like some edge case that you can try to discuss and kind of like talk fictitiously about, right? But I can't see it. I don't think believably it would ever make sense.
Good, don't do it. I'm sold, man. Congrats on everything. What an awesome project. I really appreciate your time to get to understand how it all works and get to know you better. Anything else you want to throw out there? Any people you follow or blogs or
no, I'd say more like general. I've been myself in crypto for more than 11 years. So I've been using Bitcoin since then. And the enthusiasm, the excitement, everything you can do, there's speculation, there's investment, there's build, all this other stuff. It really comes from doing things. So don't just like buy tokens and think DAOs are cool or like vote on them, like go in and do it and go through the mechanics and build certain things. And if you're not an engineer, play with all of the stuff. You can literally use Flexa today, right? You can literally take any of these tokens, download these apps, and use this stuff. Like, use it. And then figure out where you want to participate in a lot of this stuff. And there are so many opportunities for that. And it's crazy to me that 90% is really stuck on the, hey, I'm just going to buy things in a lottery and they're going to sit in my account and the number goes up and the number goes down. Like, sure, I get that that's going to be a part of this, but there's almost like so much more waiting for you that people really overlook. And then even more, if people are watching this and, you're more traditional startup people, like there's lots of stuff that is a scam and there are Ponzi's and there's other things, almost just the same as any other startup and any other technologies. But don't just write things off, right? Don't just say, oh, this is a scam or this doesn't work. Like dig into some of the technology and you'll find that there are quite a number of things that are going to be very, very powerful that'll change how a lot of these other technologies and businesses work. And, we're so early. We're in like the very beginning still. Like this is just, it seems really big to kind of us because we're in it, but it is just getting started. There's so much opportunity. So if people are, listening to this for that inspiration or anything else, it's like, hey, dig in deep, dig into a few that you really like, get into the governance, get into the software, figure out what it is. People are really open too. You'd be very surprised how you can get connected to founders and people really doing stuff. Not the people that are shilling or the people that have their blog, or that's different. Go into Discord and they'll answer you. They'll talk to you. They'll tell you how to do things. They'll give you access. Oh, man, it's wide.
It's exciting. It's an exciting time. It's like I think you're glowing with this excitement of realizing that it's like human beings just discovered a new gold mine, and it's not physical gold inside a mountain, but it's a opportunity to reconstruct how we communicate and exchange with each other in a global world. And that's just like the coolest thing in my lifetime. So keep rocking, man. Congrats on everything. And I hope you have you back on someday.
All right. Yeah, appreciate it. Thanks, Mike.
Later, Tyler.